Inflation is truly a big concern for most countries in the world, and while many are aware that it's possible to make a lot of money during inflation, still it is substantially tough to do so. This doesn't stop determined investors from always finding a way. A dollar will buy fewer products and services than it did in the past as inflation takes root, which is one of the unsettling repercussions of inflation. Yet, banks, investors, and individuals have creative ways of making money even in the toughest economies. So this video will let you in on the secret of making money in an inflationary economy. Remember to subscribe to the channel before proceeding to today's money-making tips. Let's get into it. First, what is inflation? The first step to exploiting inflation to your advantage is to understand what it means and how markets react to this economic situation. A price hike over time is referred to as inflation, and the rate of that increase is stated as a percentage. In economics, inflation tracks the rate of change in a cost of a defined basket of commodities and services and is a quantitative indicator that prioritizes quantity above quality. Usually, when inflation is high, most markets suffer. Recently, when most economies recorded historical inflation rates in 2022, investors lost a lot of money to investments such as in the stock market. It is typically not a good time to invest if you don't know what you're doing. Fortunately, it also provides some opportunities too. While the S&P 500 went down by over 60%, some other markets were actually doing well. Here are some you should be looking at. First is real estate. It does not matter how bad the economy is, people would pay for proper accommodation. Single-family homes with low rates and fixed mortgages frequently do well when inflation is high. Your home's value is likely to increase when inflation goes up, but your mortgage's monthly servicing costs will remain the same. Building home equity is fundamental to boosting your net worth, which can actually occur very quickly. You can protect yourself from rising rents by investing in real estate. Rents usually increase as inflation soars, just like it does for every other consumable commodity. Even though mortgages are far less adaptable than rental agreements, they offer a benefit when inflation is high. Due to the potential increase in property value during times of rising inflation, real estate typically performs well. As a result, if you have one, your landlord will be able to raise the rent they charge you, raising their income to keep up with the rate of inflation. So if the property belongs to you, and this should be a given, put your spare space to use instead of letting it sit there collecting dust. Renting out your underused driveway, extra parking space, or even a vacant garage allows you to start making money each month. Real estate investments can also be undertaken through REITs, sometimes referred to as real estate investment trusts, or through mutual funds that invest in REITs in addition to house ownership. Another opportunity is in value stocks. Value investing is finding shares whose intrinsic value, as determined by fundamental analysis, is below their market value and purchasing such shares. Stocks have a decent chance of keeping up with inflation, but not all equities do equally well in this regard. For instance, in inflationary times, high dividend-paying stocks sometimes experience the same kind of heavy losses as fixed-rate bonds. Looking to profit from equities during an inflationary period? Think about the stock's type. While businesses that can pass higher costs on to customers and those whose value relies on commodities will fare better, dividend stocks frequently suffer amid inflation. Value equities typically perform better than growth stocks during periods of inflation. Value stocks are businesses with high earnings in comparison to their present share price. They also have a reputation for having strong cash flows, which investors favor when prices are rising. Contrarily, growth stocks typically exhibit a greater sensitivity to changes in interest rates, which is a typical monetary policy reaction to inflation. Growth stocks had a great decade since inflation was notably absent at that time. Value stocks, however, have recently made a resurgence. Their success is likely to continue given the existing circumstances. The next investment you should be making is in commodities. A few examples of commodities are raw materials and diverse natural resources necessary for production, as well as gold and other precious metals. In other words, as demand grows, prices in the economy rise, and the cost of manufacturing to satisfy that demand often grows as well. During uncertain times, commodities are frequently viewed as safe haven investments. These commodities include, among others, agricultural products including wheat, corn, soybeans, animals, and timber. Steel, nickel, and other industrial metals typically perform well during inflation. Commodities are uncorrelated to the traditional asset classes of stocks and bonds and tend to move in different directions, although they don't generate dividends or represent any underlying businesses. You should consider putting some of your money in gold. In June 2022, consumer prices rose by 9.1% year over year across many industries, setting a 40-year record for inflation. Think about it this way. With an average interest rate of 5.84% in 1970 and a staggering average rate of 13.58% in 1980, the 1970s were a decade marked by inflation. According to NASDAQ data, the price of gold ETFs increased dramatically over that period, from $35 per share to $850 per share. Gold has long been the go-to asset to invest in to protect against inflation. Since gold is a physical asset, it usually retains its worth, unlike financial assets, which may lose value as people's purchasing power declines. Although commodities like precious metals don't always shield consumers from rising inflation in the short term, they typically do so in the long run, for example, over decades. The value of paper currency typically decreases as prices rise. This is due to higher prices caused by more paper money chasing fewer products and services. But gold keeps itself to a higher standard. Why? Because there is a limited supply and gold is scarce. Gold is still a valuable commodity today, as it has been for thousands of years. Both investors and non-investors purchase gold because of its special advantages. One benefit of purchasing and owning gold is that you don't have to worry about financial characteristics like dividends, payments, and earnings reports. Its fundamental task is straightforward, and that is to act as a long-term store of value for you. Purchasing gold is a wise move if you want to add stability to a broad portfolio, especially if you want it to act as an inflation hedge. The best investment for retirees looking to protect their principal are TIPS. TIPS are government-issued bonds that help guard against inflation since they have a rising principal value when inflation rises. TIPS likewise has a fixed interest rate and pays interest twice annually. Along with inflation, interest payments can fluctuate in value. TIPS can act as a hedge against long-term inflation, but there is a chance that short-term price losses will surpass principal adjustments. TIPS investments are not always simple to make. They have numerous distinctive qualities that can make investing in them a little complex. Since TIPS are still bonds, their prices and yields are inversely correlated. In 2022, TIPS rates soared along with the majority of fixed-income investments, driving their prices lower. Also, keep in mind that the secondary market TIPS prices do not reflect the adjusted principal value. For example, the adjusted principal value may cause the transaction amount when purchasing or selling TIPS on the secondary market to deviate from what the pricing would indicate. If the principal is greater than the initial amount when the TIP reaches maturity, you receive the higher amount. You receive the initial investment if the principal is equal to the initial amount or lower. This indicates that the ideal situation is to purchase TIPS before inflation occurs. The principal and interest increases will then be fully utilized when inflation rises. If you purchase TIPS too late in the inflationary cycle, inflation could harm your portfolio. So, keep in mind that inflation happens when there is too much money in circulation, and so money loses value due to inflation. With the aid of a financial counselor, you may respond better to inflation in a way that suits your goals, timetable, and risk tolerance. Check out our other financial education videos. Thanks for watching.